Ever feel like financial reports are written in their own secret code? Or that keeping up with accounting standards feels like, well, navigating a constantly shifting maze?
It definitely can feel that way sometimes.
Yeah, it certainly can, but understanding these foundational rules is really key to truly grasping a company's financial health. Today, we're cutting through the noise and taking a deep dive into FRS 100.
The application of financial reporting requirements.
Exactly. Our source material for this deep dive is the official document from the Financial Reporting Council itself, freshly published September 2024.
So bang up to date.
Right. And our mission, to unearth the most important, nuggets of knowledge from this pretty dense document. We want to give you a shortcut to understanding the core rules and recent shifts in financial reporting for entities here in the UK and the Republic of Ireland.
We'll try and unpack it together, yeah.
We're going to unpack this together, helping you quickly grasp what's truly important and why it matters, without getting sort of lost in the weeds.
Sounds good.
So let's start at the very top. Who exactly is the Financial Reporting Council, or FRC, and what's their role in setting the stage for financial reporting? What's the biggest pain point, maybe, they're trying to solve?
Okay, the FRC. Their purpose is fundamental, really. They serve the public interest by setting high standards for corporate governance, reporting, and audit in the UK.
Guardians of financial integrity, perhaps.
That's a good way to put it. Yeah, guardians. Beyond just setting rules like the UK Corporate Governance Code, accounting standards, they also monitor and enforce audit quality.
Right, the enforcement piece is key.
It is. Their ultimate goal is to foster market confidence. So the pain point they address is inconsistency, maybe a lack of trust. By setting clear, high standards, they ensure financial statements are reliable, comparable.
Which is vital for investors.
Absolutely. Investors, creditors, the wider economy, really.
That makes perfect sense, providing that essential trust layer. So the FRC issues FRS 100. What exactly is this standard, and what's its overarching objective in this whole financial ecosystem?
Right. FRS 100. It's a crucial accounting standard, specifically designed for entities operating in the UK and the Republic of Ireland.
Okay.
Its primary objective is to enable users of accounts, people reading them, to receive high-quality, understandable financial reporting, but also, importantly, reporting that's proportionate.
Ah, proportionate. That sounds important.
It is. It's key. It means the reporting burden isn't, the same for a tiny business as it is for a huge multinational.
Right, that would make sense.
Exactly. So, in essence, FRS 100 acts as the ultimate guide. It helps entities figure out precisely which financial reporting framework they should actually apply.
It's the which way do I go standard.
Pretty much, yeah. And it applies to any financial statements consolidated, individual that are intended to give a true and fair view.
That old chestnut, true and fair view.
That overarching principle, meaning the accounts faithfully represent the entity's financial position and performance, it's foundational.
So with all these foundational elements in place, the core question for businesses then becomes, okay, which standard applies to me? How does FRS 100 guide them through that?
Yeah, that's really the heart of FRS 100. It lays out a structured approach with a few primary options.
Okay.
First, if an entity is eligible as a micro-entity, and that's a legal definition, very small businesses based on turnover, balance sheet, employees.
A really small guy.
Exactly. It's an option, prepare the financial statements using FRS 105.
FRS 105. And that's the simplest one.
That's the most simplified approach, yeah. Really designed to minimize the compliance burden for the smallest players.
Got it. What if you're not micro or choose not to use 105?
Right. If an entity isn't eligible, or they are, but choose not to use it, they must prepare their statements according to one of these. FRS 102, adopted IFRS, or...
There's the third one.
Yes, or if it's the individual financial statements of what's called a qualifying entity, think a subsidiary or parent that uses adopted IFRS in his group accounts, then FRS 101 is an option.
Okay, so FRS 102. Adopted IFRS, or maybe FRS 101. Can you quickly demystify those?
Sure. FRS 105, as I said, is for micro-entities, streamlined based on 102. FRS 101 offers an optional reduced disclosure framework, mostly for those qualifying entities.
The fewer notes, basically.
Fewer notes, yeah, less disclosure burden. Then we have FRS 102. That's essentially the main single standard for the vast majority of entities not using adopted IFRS 101 or 105.
The default for many, then.
It's the go-to for many, yes. And adopted IFRS, that just refers to the International Financial Reporting reporting standards as adopted in the relevant jurisdiction. So UK adopted standards here, EU adopted IFRS in the Republic of Ireland.
Okay, got it. So it's definitely not one size fits all. It's a tiered system
Yeah,
designed for different types of entities that makes perfect sense for proportionality.
exactly.
But I can imagine some industries, like, say, charities or pension funds, having really unique financial realities. Do they ever feel squeezed by these general standards, or is there a way FRS 100 helps them navigate their specific needs?
That's a great question, and it's precisely where statements of recommended practice, or SORPs, come into play.
SORPs.
Yeah, SORPs. They're developed by specific industry bodies to recommend accounting treatments and disclosures tailored for their specialized sectors. You mentioned charities, pension funds, housing associations are another example.
Oh, so they add detail on top of the main standards.
Exactly. Their role is to supplement the main accounting standards, like FRS 102, bridging any gaps and ensuring comparability within those niche areas. It stops that one-size-fits-all problem for union entities.
Right. And how does FRS 100 interact with them?
Well, for entities applying FRS 102, the document is clear. They must state the SORP title they're following and confirm their compliance.
So you have to declare it.
You do, and what's particularly insightful for transparency is if there's ever a departure from SORP's provisions.
You mean if you don't follow a specific SORP recommendation?
Precisely. The entity must briefly describe why that different treatment was judged more appropriate. They also need to detail any disclosures the SORP recommends that they haven't provided and explain why.
That's quite thorough. It's not just ticking boxes.
Not at all. It's about explaining why you might need to adapt the rules, which, significantly strengthens user understanding and trust.
That focus on explaining deviations is interesting. Does that imply a greater burden on companies, maybe? Or does it ultimately streamline things like auditing by providing that upfront context?
It's probably a bit of both, but the primary goal is better transparency, which should help everyone in the long run.
You mentioned earlier that these standards are living documents.
They certainly are.
What have been some of the most significant updates or changes we've seen in FRS 100, particularly thinking about this September 2024 edition?
Yeah, FRS 100 is definitely dynamic, constantly adapting. Since it first applied, back for periods starting on or after January 4th, 2016.
Which feels like a while ago now.
Doesn't it? We've seen several significant amendment cycles. There have been various triennial reviews and now periodic reviews.
Like the 2017 and 2024 ones.
Exactly. These are essentially comprehensive health checks. The FRC fine-tunes the standard based on feedback, evolving practices. For instance, the periodic review 2024 amendments approved March 24, effective from Jan 1, 2026. So
Coming up soon?
coming up soon, yeah. They reflect consequential changes made to FRS 102, just keeping everything aligned.
Okay. Any other big ones?
Well, we also saw crucial, more targeted amendments, like the 2018-19 FRS 101 amendments effective from Jan 1, 2023.
What do you do?
They notably changed the definition of a qualifying entity. They excluded entities required to apply specific rules under Schedule 3 to the regulations and whose business includes insurance contracts.
Because of IFRS 17 for insurance.
Precisely. That's governed by the very detailed IFRS 17 standards, so this change avoided overlapping or, contradictory requirements for those specific entities.
Makes sense.
And, of course, the UK's exit from the European Union also prompted amendments, effective from January 1st, 2021, to reflect changes in UK company law and also just to standardize adopted IFRS across both UK and EU contexts.
Wow, that's a lot of significant shifts. When standards evolve this much, how challenging is it for businesses, especially maybe smaller ones, to keep pace? Is there a sense of rule fatigue that FRS 100 tries to mitigate?
Rule fatigue is definitely a real concern, absolutely, which is why that proportionality objective we talked about is so important.
Right.
And the transitional arrangements are key, too. These provide specific guidance for entities moving between different standards.
How so?
Well, for example, if an entity is transitioning to adopted IFRS, they apply the rules set out in IFRS 1.
Which is specifically for first-time adoption.
Exactly. It gives them a clear roadmap. Similarly, for qualifying entities transitioning to FRS 101, they follow requirements that are similar to IFRS 1. And crucially, if this change has a material effect on their financial statements, They have to provide specific reconciliations of equity and profit or loss.
So showing the impact of the change.
Yes, it's not just compliance. It provides transparency to users about that impact, helps them understand how the financial picture might look different under the new framework compared to the old one.
And there are similar arrangements for FRS 102 and 105.
Yes, there are specific transitional arrangements for moves to FRS 102 and FRS 105 too, all detailed within those standards themselves. The aim is always to ensure as smooth a handover as possible.
Now, let's talk about a concept that might sound straightforward but carries significant weight and, it seems, allows for some fascinating flexibility. Equivalence.
Yes, equivalence.
What's the practical power behind this term, and how does FRS 100 apply it in, well, real-world scenarios?
Indeed, the interpretation of equivalence section in FRS 100 is particularly insightful. Its purpose is really to provide guidance on interpreting equivalence in several key contexts.
Like what?
For instance, it applies when a UK or Republic of Ireland intermediate parent company seeks an exemption from preparing its own group accounts.
They can do that.
Sometimes, yes. If its immediate parent's consolidated accounts are drawn up in a manner considered equivalent to UK or EU standards, it's about recognizing that robust reporting can come from different frameworks globally.
Interesting. Where else does it pop up?
The concept also extends to disclosure exemptions within FRS 101 and FRS 102. These standards permit certain disclosures to be omitted if equivalent disclosures are already included in the group's consolidated financials.
Avoiding duplication.
Exactly. And even for specific things like share-based payments, FRS 102 allows an alternative measurement if the expense is calculated on an equivalent basis.
So what's the principle here? How equivalent does it need to be?
Well, the core principle when assessing equivalence isn't about demanding strict compliance with every single tiny detail of another framework.
It's not a checklist then.
No, not a rigid checklist. Instead, it focuses on whether the basic requirements are met, especially that critical true and fair view principle we mentioned.
So it's more qualitative.
It's a qualitative assessment, yes, which aligns with the sort of deregulatory nature of these exemptions, allowing flexibility without sacrificing the quality of information.
Are there any frameworks that are just automatically considered equivalent?
Yes. To give you some concrete examples, major global accounting frameworks, GAAPs, from places like Canada, China, Japan, Korea, the US. They're formally recognized as equivalent to UK-adopted international standards and EU-adopted IFRS.
That's a powerful allowance for global business. But what if it's not on that formally recognized list? Can a company still claim equivalence for its reporting? What are maybe the pitfalls there?
Yes, absolutely. For the group account exemptions specifically, directors may make their own assessment of equivalence even without that formal recognition. They do it by following the principles laid out in the relevant companies' acts and this application guidance in FRS 100. Always with that overarching focus on whether the financials present a true and fair view.
The challenge must be the subjectivity, though.
That's the main challenge. It requires careful judgment, and entities really need to be prepared to robustly defend their assessment if it's ever challenged.
And for the disclosure exemptions,
Yeah.
how does equivalence work there?
Well, equivalent disclosures can sometimes be made in aggregate or maybe in abbreviated form, or even for intragroup balances that get eliminated on consolidation anyway.
Okay.
But, and this is a crucial caveat, it highlights the spirit of the standard if a disclosure isn't made at the consolidated group level because it's deemed immaterial there.
Right.
It should still be made at the subsidiary level if it is material in that specific entity's financial statement.
So materiality is key at each level.
Exactly. It ensures users always have access to relevant information where it truly impacts their understanding of an individual entity. It's about applying common sense and materiality even within that flexibility.
Okay, that makes sense. Finally then, to really understand where we are with financial reporting today, it's always helpful to know where we've come from. What did FRS 100 and its accompanying standards effectively replace? What was the old world like?
Right. FRS 100 and its related standards, 101, 102, 105, essentially ushered in a completely new era. They swept away a significant portion of the older UK GAAP framework.
Like what specifically?
Well, all the previous SSAPs, statements of standard accounting practice, the older FRSs, financial reporting standards, and UITF abstracts. These were urgent issues task force
Oh, I
things.
remember those acronyms.
They were all formally withdrawn for accounting periods beginning on or after January 1st, 2015. It was a huge streamlining effort, really.
A big clear out.
A very big clear out. And crucially, the financial reporting standard for smaller entities, the FRSSE.
Ah, the FRSSE, yes. That was huge for small businesses.
It was a cornerstone for small entity reporting for many years. That was also withdrawn for periods starting January 1st, 2016.
And what replaced it mainly?
Its role was largely taken over by a new section within FRS 102, Section 1A, Small Entities. This provides updated presentation and disclosure requirements tailored specifically for small entities, maintaining that proportionality we keep coming back to.
So it was about modernizing and simplifying.
Exactly. Consolidating lots of disparate rules into a much more cohesive system under the FRS 100 umbrella.
So FRS 100 truly acts as this central guide, doesn't it? Defining the financial reporting landscape for entities across the UK and Republic of Ireland.
It really does. It sets the scene.
It's clearly a remarkably dynamic standard, constantly adapting through those amendments and offering practical flexibility, especially through that really nuanced concept of equivalence.
Yeah, that flexibility is important in a globalized world.
So hopefully you listening now have a much better foundational understanding of which standards apply to different entities and why, cutting through what can often seem like a pretty dense forest of regulations.
If we connect this to the bigger picture, FRS 100 isn't just some static rule book. It really is a living, breathing framework. It's ensuring consistent, transparent, and, yes, proportionate financial reporting.
And its constant evolution reflects the changing landscape.
Absolutely. The changing economic, legal, and, global landscape. It's designed to keep financial reporting relevant and understandable.
So here's a final thought to leave you with. Given the ongoing global nature of business, the constant push for more transparent reporting, and the FRC's clear commitment to continuous review, how might the definition and application of equivalence continue to evolve in the coming years?
That's a fascinating question.
Could we see new challenges arise from, say, emerging digital assets? Or maybe novel international business structures that might really test the boundaries of that true and fair view under the existing frameworks? Something to ponder.